Biden's latest mortgage assistance can cut your monthly payment by up to 25%, according to this article by Yahoo Finance. So let's get right into the story. So while most U.S. homeowners have come through the pandemic unscathed, or even further ahead thanks to money-saving refinances at cheap mortgage rates, millions of others have to opt for forbearance to put their loan payments on hold. A federal foreclosure ban provided them further protection. Now those safeguards are falling away. The more than 1.74 million mortgages were still in forbearance as of August 10th. According to the mortgage data and technology provider Black Knight, the foreclosure moratorium expired on July 31st after multiple extensions. So some homeowners may find themselves unable to resume their regular payments if lenders refuse to extend their forbearance periods. But if that's the boat you're in, new initiatives from President Joe Biden's administration could help you afloat. So in June, when Biden extended the foreclosure moratorium for a final time, he also extended the forbearance application deadline for borrowers with government-backed loans to September 30th. Time is running out if you have a mortgage and you can't pay through the Federal Housing Administration or the FHA, the U.S. Department of Agriculture, USDA, or the Department of Veterans Affairs, VA. So in recent weeks, the White House has announced additional assistance also for government-backed loans. So the FHA loans. To keep borrowing costs manageable, mortgage servicers are being instructed to offer FHA borrowers who can resume regular payments the option to move any payments they missed to the end of their mortgages at no additional expense, which, in my mind, that's the best way to do it. If you were to do it, is just to move it a few months down the line. But either way, none of this is actually really good. So for those who can't get back on track, the White House says the Department of Housing and Urban Development will enhance servicers' ability to provide all eligible borrowers with a 25% principal and interest cost reduction. That reduction isn't quite as simple as it sounds. Known as the COVID-19 Recovery Modification, it involves extending the term of your FHA loan to 360 months at market rate. So your monthly payments will certainly be less, but you're making a lot more of them over the next 30 years. So HUD also is offering what it calls the COVID-19 Recovery Standalone Partial Claim, where FHA borrowers can get access to a zero-interest lien to fund their mortgage payments. The lien will be repaid when you sell your home or refinance your property. The options aren't ideal, but they're better than defaulting on your mortgage. I agree. So the thing is, if someone's in this situation, in my mind, I view it a lot better as to just put this as an extra month or a few extra months instead of you basically being late or anything like that. That makes the most sense to me. But either way, none of this is really great. And basically, if you're in this situation, you're going to have to find some sort of money and start paying your bills, because no matter what, you're still having to pay that bill no matter what, right? Like, you have to pay that bill. So USDA loans. The USDA's COVID-19 special relief measure can help borrowers achieve up to a 20% cut in their monthly payments. The options available to USDA borrowers who are enrolled in some suburban areas include a reduction in interest rate, term extensions, a mortgage recovery advance to cover past due mortgage payments, and other related costs. That is something I really don't like, the mortgage recovery advance, because the way that it kind of sounds like just reading this is basically like you're taking like another loan to pay off your past due and current expenses to add, like, to basically get into more debt, basically. And I don't really like that at all. Term extensions, I don't really like that. But a reduction in the interest rate, that's good, because obviously you're spending less money on interest, which is saving you money, and that savings and interest can actually be applied to your principal, right? So in a sense, you could technically put more money to the principal debt. Meaning, instead of paying so much to the government and all that kind of stuff or to the companies, you could end up spending more money to your actual debt amount, meaning you could get rid of it a lot faster. So I like the reduction of the interest rate. I just don't really like the term extensions, and I don't really like a mortgage recovery advance, because another way to view it is like, let's say that you were to sell a book, right? And you got $1 million advance from a publishing company, right? For a book deal, right? Well, guess what? That $1 million isn't really $1 million, right? They basically prepaid you $1 million until basically it sells basically $1 million, right? So what that means is that, let's say that your book ends up not selling $1 million. Let's say that it only sells like $100,000 worth of copies, right? That means you got to pay them back $900,000. Okay? So that's something that you really got to understand when it comes to an advance. Like, it's not free money. You're getting into debt. So you're already in debt. You're having to deal with all these issues because you're in debt. And now you're going to take even more debt to try to help with your current debt. Like that's like basically using a credit card to pay another credit card to pay another credit card. Like, it's just absurd. It doesn't solve the actual problem. So borrowers will have their interest rates reevaluated, and if a lower rate won't achieve the target 20% reduction, a rate reduction / term extension combination will be considered. If that still doesn't do it, a mortgage recovery advance will be added to the equation. So VA loans. Holders of VA mortgages also can achieve a 20% reduction in their monthly mortgage payments. The VA's COVID-19 refund option allows the VA to purchase a borrower's mortgage payments that are in areas, and in some cases, up to 30% of the unpaid principal balance. Borrowers must then pay back the Department of Veterans Affairs, but at 0% interest. See, I kind of like the 0% interest thing, but at the same time, though, it's just basically more debt. So payments can be brought lower if VA borrowers and their servicers agree to stretch out the loan. VA loans can currently be extended by up to 120 months, potentially making the repayment term a full 40 years. I really don't like that. I don't really like the idea of people getting into debt for 40 years. Like, that's just insane. Okay, so conventional mortgages. While no new payment reduction programs have been put in place for borrowers with conventional mortgages associated with Fannie Mae or Freddie Mac, it's worth remembering that there is already help available if either of the government-sponsored mortgage giants owns their loan. You can defer your payments for up to 18 months without incurring any interest penalties, and those missed payments don't have to be repaid until you sell or refinance your property. If you need further assistance, loan modification options exist that can cut your monthly mortgage payments by 20%. And note that $10 billion in aid was made available to states in the most recent COVID-19 aid package to help owners pay not only their mortgages but also taxes, utilities, home insurance, and homeowners association dues. Now, the thing is, yes, technically this is true, but all the states have basically sucked horribly in their implementation of actually paying for all this. They try to do some like weirder deals where like landlords have to like pay like half of this stuff. They might not do all of it. They might only do like 10% of it. They haven't put any systems in place to actually dish out the money. It's just like a whole mess of a problem, right? So yeah, even though technically there's enough money to potentially ease the issue, it hasn't really been going to anyone at all, period. Dun, 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 dun. So if you're worried about where your next mortgage payment is going to come from, there are a few steps you can take to chisel out some room in your budget. First, if you've been making your payments regularly and are still in good standing with your lender, consider refinancing your mortgage. With today's low mortgage rates, you could save hundreds per month with a refi. Now, I agree with this. If you could get a lower interest rate, you should, right? If you could do it at like no extra cost to yourself, yeah, go ahead and refinance your mortgage. That being said, if you do that, put more money towards your principal so that you could pay off your house. So if you're carrying multiple high interest debts like credit card balances, they're no doubt eating into your cash flow. I agree. You could also consider rolling all of your high interest debt into a single low interest debt consolidation loan. You'll pay less in interest costs and wipe those debts off your books sooner. Now, here's the thing. I personally think that this is not that great of an option unless you're capable of doing this within a 12 to 24 month time span, right? For example, there's like a lot of deals out there where you have like credit cards or banks basically saying like, hey, we can offer to transfer all of your debts into one main like singular bill, one debt balance for no interest for 12 months to 24 months, right? So that would only make sense if you could actually pay off the total amount of that balance within that time frame. Because if you can't, you're going to get hit with a massive monthly interest rate that is going to destroy your cash flow. It is going to destroy your finances. So if you're living paycheck to paycheck, you're not going to probably be able to do this, right? But if you're someone who's able to make a lot of money very quickly, and you just do this to save you a little bit extra money, that makes sense. But if you're living paycheck to paycheck, this can become a very dangerous option that most people might not actually think about. And here's the thing, like a lot of people end up actually getting stuck into this type of situation. They're like, oh, this is like my chance to like get out of debt or like, have like less monthly bills and all that kind of stuff, right? Like have more money coming in per month, which technically is true. But if you have like, if you had like $50,000 in like different types of credit accounts, right? And then you move all of that into like one massive debt amount of $50,000, and then you get hit with like a massive like 22% or 20% APR, you're going to get screwed harshly, right? It's going to get really bad very quickly for your finances. And a lot of people do not think about that, and they should. You also can improve your financial situation by bolstering your income. There's a colossal hiring boom happening in America right now, so it's not a bad time to look for a higher paying job or take on some cash generating freelance work. I agree. Or you can take a crack at today's still hot stock market without risking your life savings. A widely popular app can help you invest in a diversified portfolio using little more than the spare change from your everyday purchases, called Acorns and all that kind of stuff. So yeah, I thought that this was an interesting article. I really only agree with basically one thing, and that's basically lowering the interest rate of these things, because it just allows people to have more money going to principal if they kept the same payment basically. But still at the same time, with anything that like the government tries to say that they're doing for like the benefit of the people, read between the lines and basically think like, okay, is this actually a benefit, or are they trying to make us a slave for the rest of our lives? Because the VA example was like pretty spot on. So instead of like a 30-year mortgage, you're going to go into debt for 40 years, paying off debt for 40 years to the government. How crazy is that, right? Like you already served the country and now you're going to have to be basically a slave to the country for 40 years. That is insane. So anytime you get into like these debt, like refinancing or like loans, like anytime you're dealing with loans at all, be very careful and look at everything that's going on, because there's a high chance that you might be screwed in a way where you can't really recover from. I mean, I think everyone can get out of debt, but it's going to get super, super difficult for you for probably a very long time if you're not careful. By the way, if you need help with mastering your money, go check out 14bucks.com to learn the secret to mastering your money. And we'll see you in future episodes. If you like this sort of thing, hit the like button. Share this with someone if you think they need to see this. And we'll see you in future episodes. Peace out.